Hi, everyone, and happy Tuesday, the 28th of February. So, we want to talk about US and European equities. It's been a slightly frustrating 6 weeks because all our data driven indicators have kept us firmly in neutral territory. But that is now starting to shift as of the last couple of days. And it's interesting because what we're seeing is lots of little bearish indications. Rather than one big, compelling, clear signal, we are seeing lots of little hints. So let's go through them. Firstly, we can see that the macro warranted model values for European equities are just drifting very slightly lower, and the same is true for US equities. Given the rally we've had in both US and European equities, we're now seeing that actual markets are trading a couple of percent above macro warranted value. So there's perhaps a small edge there. What is more interesting is that, as we said in December and early January, two big drivers of global equity markets now, and we see this from the sensitivity data, are number one, real GDP growth, and number two, the credit cycle. And the way we measure the credit cycle is the cost of corporate borrowing or corporate credit spreads. And when we look at the spread models, corporate credit spreads are very much a function of financial conditions. And what we've seen as we've had these much stronger inflation prints is that the Fed terminal rates are being priced higher, financial conditions are tightening. And what that is doing is it is moving the macro warranted credit spread higher. And so we're seeing credit spreads anywhere from 20 to 40 basis points too tight to where the evidence tells us they should be. So one of the big inputs for equities, credit spreads, look like they're set to rise, and that would be negative for equities. So that's the second point. The third point is that we have seen positioning shift, and there's a lot of evidence to show that the bearish sentiment has dissipated over the last couple of months, and there has been a lot of short covering. The fourth point, and there's been a lot of focus on this recently, is that the equity risk premium has started to compress even further. And that's happened because you've seen bond yields rise, but the expected yield on equities hasn't really shifted. And in fact, there was a large investment bank that used the term the death zone for where the current equity risk premium is. Now, there are two ways that the equity risk premium can correct. One is that equity prices can go down. Two is that bond yields can go down. That is a way for the equity risk premium to widen out and for the picture to normalize. But given the inflation prints we've had, it seems unlikely that bond yields can really move appreciably lower from here, at least in the near term. Finally, the one dimension of investing that isn't really aligned quite as yet is the trend. Equity markets are not showing a short or medium term downtrend as yet. So to summarize, lots of little hints, particularly from credit, that indicate bearish lean for equities, but we're watching the trend and the trend formation very closely. Good luck out there.